All right, let's dive into one of the most important and, frankly, controversial corners of the crypto universe, stablecoins. You see, they're built to solve crypto's single biggest problem, but, as we'll find out, they might just create a few massive new ones along the way. Let's get into it.
You know, it really all starts with two pizzas. Way back in 2010, a programmer named Laszlo Hanyecz made history. He completed the first ever real-world transaction using Bitcoin, paying 10,000 Bitcoins for two large pizzas. Now at the time, that was worth about 41 bucks. Today, those same two pizzas would be worth hundreds of millions of dollars. And that one story perfectly captures the exact problem that stablecoins were invented to fix.
I mean, think about it. You just can't use a currency to buy your groceries or pay your rent if its value can swing up or down by 10% in a single afternoon. This crazy volatility is exactly what makes things like Bitcoin a paradise for traders, but an absolute nightmare for everyday commerce.
And the scale of these price swings is just wild. For example, Bitcoin went from around $6,000 in March of 2020 to over $63,000 just 1 year later. And then it crashed by almost 50% in the following 2 months. Just imagine buying a coffee and realizing an hour later that you either paid double what you should have, or the cafe you bought it from just lost half its money. It's just not a sustainable way to run an economy.
So, the crypto world needed an answer. It needed a way to get all the amazing benefits of the blockchain. You know, the fast, global transactions without a middleman, but without those stomach-churning price swings. And that's where the stablecoin comes into the picture.
So what is a stablecoin really? Well, putting it simply, it's a crypto token that's designed to always be worth a specific, stable amount. And that amount is usually $1. Think of it as a bridge designed to give you the best of both worlds, the power of crypto technology with the boring, predictable stability of old-school money.
Okay, but how do they actually pull that off? I mean, how do you take a digital asset that lives on the internet and glue its value to something in the real world and make it stick? Well, it all comes down to the collateral. It's all about what's backing it up. And as you'll see, there are a few very different ways to do it.
You've basically got four main flavors. The most common by far are fiat collateralized, which means for every digital coin, there's a real dollar sitting in a bank somewhere. Then there are crypto collateralized coins, which are backed by a basket of other cryptocurrencies. It's more decentralized, sure, but way more complicated. You also have commodity-backed coins, which are pegged to things like gold. And finally, you have the riskiest, most experimental bunch, algorithmic stablecoins. These guys use complex code, not collateral, to try and hold their value.
Now, even though there are all these different methods, the market has clearly picked its favorite. Fiat-backed stablecoins like Tether's USDT and Circle's USDC just completely dominate the field, making up more than 90% of the entire market. And the concept behind them is beautifully simple. For every one digital dollar out there, there's supposed to be one real US dollar, or something just as safe, held in a reserve to back it up.
And this is where our story gets really interesting. Because for all the incredible promise of stability and efficiency that stablecoins offer, they also open the door to a whole new world of potential dangers. It's a classic tale of promise versus peril. Let's start with the promise. The market for these things just exploded, at one point peaking at over $180 billion in total value. Now that number goes up and down, but what it shows is a massive global demand for a digital dollar that can zip around the world instantly, 24/7, with no bank required.
And people are using them for some really powerful stuff. In parts of the world like sub-Saharan Africa, sending money home to your family can be up to 60% cheaper using stablecoins. They're also the absolute lifeblood of decentralized finance, or DeFi, powering everything from lending to borrowing on the blockchain. And for people living in countries with runaway inflation, stablecoins offer a crucial way to protect their savings by holding on to a digital version of the US dollar.
But now, let's talk about the peril. Because while stablecoins might fix crypto's volatility problem, they bring their own set of risks to the table. See, with traditional money, you worry about things like inflation or what the central bank is doing. With stablecoins, you have to worry about the people and the code running them. Are the reserves really there? Can you actually trust the company that issued the coin? What happens if it all just breaks?
And we don't have to imagine what happens when things go wrong. We have a chilling, real-world example. In May of 2022, an algorithmic stablecoin called TerraUSD, or UST, completely fell apart. It wasn't backed by dollars, but by a super complex algorithm. When the market lost faith, the whole system collapsed into what they call a death spiral, vaporizing over $40 billion of value and sending shockwaves of distrust through the entire industry.
The Terra collapse was a gigantic wake-up call.
All of a sudden, regulators all over the world, who had been kind of watching from the sidelines, snapped to attention. The race was officially on to build some rules for this incredibly fast-growing and obviously very risky part of the financial world.
In the United States, the legislative proposals have really focused on the fundamentals. First, making sure stablecoin companies actually have the money they claim to have in their reserves. And second, stopping them from making false claims, like saying they're backed by the government when they're absolutely not.
The European Union, on the other hand, has gone way further with its MiCA framework. That stands for Markets in Crypto Assets, and it's basically a comprehensive top-to-bottom rulebook that dictates everything from how reserves must be managed to what rights consumers have, creating one clear set of rules for the entire bloc. Meanwhile, you've got major financial hubs like Singapore moving fast to create their own frameworks. Their focus is all about ensuring stability and making sure these companies have enough capital, basically trying to position themselves as a place where crypto innovation can happen, but responsibly.
So you take all of this together, the insane growth, the spectacular failures, the global race to regulate, and it all leads to a much, much bigger question. What is the ultimate place for stablecoins in the future of money itself?
This really puts it all into perspective. You can see that compared to traditional money, stablecoins are way faster and more accessible around the world. But they come with a higher risk, a risk tied directly to the company that issues them. And when you stack them up against potential central bank digital currencies, or CBDCs, stablecoins are a private sector innovation, but they don't have the full faith and credit of a government behind them. They live in this really unique, incredibly powerful, and kind of precarious middle ground.
And so we're left with this huge question. Are these digital dollars the essential bridge we need to connect the old financial world to the new one, making money truly instant and global? Or are they a fragile house of cards, a systemic risk that could bring down the very system they're supposed to be improving? The honest answer is, nobody knows for sure. That story is being written right now, one transaction and one new regulation at a time.